July 2001, Hanoi, Vietnam. The global price of coffee has just fallen below 45 cents per pound. That is the lowest price in 30 years. Adjusted for inflation, it is the lowest in recorded history, and it is less than half what it costs most farmers to grow a single pound. 25 million farming families across 45 countries are losing money on every harvest they bring in. The more they grow, the more they lose. And they cannot stop growing because coffee trees take 4 years to produce their first crop, and a farm that pulls its trees is a farm that earns nothing for 4 years while its debts accumulate. Ethiopia, where coffee was born, has hospital wards filling with malnourished children from farming communities. Guatemala has abandoned villages. Uganda has farmers burning their trees for charcoal because that is worth more than the beans. And in the center of this catastrophe is a country that had almost no coffee industry 15 years earlier and now produces more of it than almost anyone on earth, flooding a market that was already oversupplied, driving prices to levels that destroy livelihoods across 4 continents. How does the most consumed hot beverage on earth become so worthless that the people who grow it cannot afford to feed their children? And why does the commodity price collapse that obliterated 25 million farming families between 1999 and 2004 keep reappearing in cocoa, in cotton, in palm oil, in every agricultural commodity where the same structural trap gets rebuilt by a new generation of producers who have never read the last chapter? This is the story of the coffee price collapse. By the end, you will understand the specific economic mechanism that turns agricultural abundance into farmer poverty. See how that mechanism is operating right now in commodities that are in your kitchen and your fuel tank, and recognize why the standard solutions offered to poor farmers keep making their situation worse. It is the mid-1980s in Bogota, Colombia, and the smell of roasted coffee hangs over the city the way coal smoke hung over industrial London. Familiar and inescapable, a scent that is also a promise. Colombia grows some of the finest Arabica coffee in the world, harvested on steep Andean hillsides by smallholder farmers who have been growing coffee for 3 generations, and the country's entire economic and cultural identity is organized around the crop. The National Federation of Coffee Growers, de Federación Nacional de Cafeteros, or FEDECAFE, is one of the most powerful private institutions in the country, managing a price stabilization fund that smooths out revenue for farmers when world prices fall, funding rural infrastructure, running schools and health clinics in coffee-growing regions. Coffee is not just a crop in Colombia, it is the organizational principle of rural society. The global coffee market in the mid-1980s runs under a system called the International Coffee Agreement, a cartel arrangement between producing countries and consuming countries that sets export quotas to keep prices within a target band. The ICA has been in operation since 1963, and it works reasonably well at its stated goal of price stability. Producing countries agree not to export above their quota. Prices stay between roughly $1 and $1.50 per pound. Farmers plan around this. Banks lend against it. Governments budget against it. The arrangement is imperfect, subject to cheating by countries that sell above quota coffee to non-member markets, and resented by consuming country importers who would prefer to buy at whatever price competition produces. But it keeps 45 countries' worth of rural economies stable. The crack in the ICA comes from within. Brazil, the world's largest producer, has long believed that its quota constrains it unfairly relative to smaller producers. The United States, under pressure from the coffee roasting industry, wants cheaper beans. Non-member consuming countries, particularly in Eastern Europe, are receiving above-quota coffee at lower prices and re-exporting it to ICA members, undermining the whole system. In July 1989, the export quota clause of the ICA collapses. The producing countries cannot agree on a new quota formula. The cartel is over. Coffee prices drop 50% within a year and keep falling. Meet Jorge. He is the general manager of FEDECAFE from Ijo Barsan to Arling Lingar, a technical economist who has devoted his professional life to the Colombian coffee sector, and he understands immediately what the ICA collapse means. He travels to Washington and to Geneva and to Brussels to lobby for a new agreement, a price stabilization mechanism, anything that will prevent the free market from doing to Colombian farmers what it is about to do. He is received politely. Nothing happens. The consuming countries and the large roasting companies, Nestle and Kraft and Procter & Gamble, are delighted with lower prices. They have no incentive to support a new cartel that would raise their input costs. Cardenas returns to Bogota and spends the next decade trying to hold together a system that the market is methodically destroying. But Starbucks sees the post-ICA world differently. Howard Schultz opens the first full Starbucks store in Seattle in 1987, 2 years before the ICA collapse, and through the 1990s he builds a retail model that charges $3 for a cup of coffee, whose bean content costs roughly 3 cents at wholesale prices, capturing the lion's share of value in the supply chain at the retail end, while the commodity price at the production end falls toward its historic floor. Starbucks is not responsible for the coffee price collapse, but the distance between $3 in a Seattle cup and 3 cents in a Colombian farm demonstrates with precision where the value in the coffee supply chain actually accumulates, and it is not at the end where the growing happens. And then there is Nguyen Van Hung. He is a farmer in Dak Lak province in Vietnam's Central Highlands in 1990, growing rice and vegetables on 2 hectares of red volcanic soil, earning enough to feed his family but not enough to build anything. The Vietnamese government, liberalizing its agricultural economy after the Doi Moi reforms of 1986, is actively encouraging coffee production as a hard currency export crop. The World Bank, along with several bilateral aid agencies, funds the expansion, providing technical assistance, seedlings, and credit to farmers across the Central Highlands. Nguyen plants his first Robusta coffee trees in 1991. By 1994 they are producing. By 1997 he has quadrupled his planted area. By 2000, Vietnam is the second largest coffee producer in the world, having grown from producing essentially nothing to producing 900,000 metric tons per year in less than a decade. What none of them know yet is that every new tree planted in Dak Lak is adding weight to a market that is already bending under its own supply. The acceleration of the coffee crisis follows the mechanics of what economists call the commodity trap with a precision that textbook writers could not improve on. The ICA quota collapse in 1989 sends prices lower. Lower prices hurt farmer incomes. Governments and development agencies, watching farmer incomes fall, conclude that farmers need to produce more efficiently and at higher volume to compensate, and so they provide technical assistance, credit, and new cultivars to increase yield. Higher yields mean more supply. More supply drives prices lower. Lower prices hurt farmer incomes. Governments and development agencies provide more assistance to raise yields. The loop runs forward with each cycle, compressing prices further. Brazil, the largest producer, attacks the efficiency problem with industrial agriculture. Between 1990 and 2000, Brazilian coffee farming undergoes a mechanization and consolidation transformation that increases productivity per hectare by roughly 200%. The Cerrado region of Minas Gerais, with its flat terrain and predictable rainfall, becomes a coffee factory running mechanized harvesting equipment over vast planted areas, producing Robusta at costs well below what any smallholder in Colombia or Guatemala can match. By 2000, Brazil's production costs are estimated at 60 cents per pound at a time when world prices are heading toward 45 cents. At 45 cents, even Brazil barely breaks even. Every smallholder in the developing world is losing money on every bag they export. Olga Mejia grows coffee on a 4-hectare farm on the slopes above Manizales in Colombia's coffee belt. Her family has grown coffee here since her grandfather cleared the land in 1952. In 1994, when world coffee prices briefly spiked to $2.50 per pound after a frost in Brazil kills a large portion of the Brazilian crop, she earns enough in a single year to build a concrete house and send her 2 daughters to secondary school. By 1999, prices are back below 80 cents and falling. By 2001 they are at 50 cents. Her production costs are 85 cents per pound. She is losing 35 cents on every pound she ships. She has no alternative crop. The coffee trees are sunk costs that take 4 years to replace with anything. She borrows from the local cooperative to buy fertilizer and pest control, adding debt to losses. Unable to exit the trap because the exit requires time she cannot afford. Paul Katzef is the founder of Thanksgiving Coffee Company in Fort Bragg, California, a specialty roaster who has been working directly with coffee farmers in Central America and Africa since the 1980s. He is one of the early advocates for what becomes the Fair Trade Certification movement, arguing that consumers will pay a premium for coffee whose farmer receives a guaranteed minimum price. By 2001 he is watching the price collapse with a specific kind of anguish, knowing that the farmers he has built relationships with over 20 years are in acute crisis and that the retail consumer 3,000 miles away is paying the same, $3 for their morning latte, while the person who grew the beans is choosing between buying food and buying school supplies. He publishes an open letter in 2001 calling the crisis a humanitarian emergency, created by the market's indifference to the human cost of commodity prices. The letter is read by other specialty roasters. It is not read by Kraft or Nestle. The peak of the overproduction cycle, the moment of maximum global coffee output into minimum demand growth, arrives in the crop year 2000 to 2001. Global coffee production reaches 115 million bags of 60 kilograms each. Global consumption is approximately 105 million bags. The 10 million bag surplus pushes warehouses to capacity, and the price breaks through 50 cents per pound on its way to the historic floor. In London, traders at the LIFFE Futures Exchange are making money on the way down, the same way traders made money on the way up. Coffee is a commodity. The direction of price movement is irrelevant to a trader with the right position. It is only the farmer with trees in the ground who has no position to take. This is the top. Nobody knows it yet. Then something happens that nobody in the supply chain predicted. In 2002, Vietnam's Robusta output, which had grown from near zero to over 1 million metric tons in a decade, plateaus. Brazilian production fluctuates with weather. Global coffee consumption, which the large roasters had been forecasting to grow by 3 to 4% annually, slows, and a small but growing specialty coffee sector, led by Starbucks and by independent roasters paying above market prices for high quality, begins absorbing a portion of Colombian and Central American output at prices well above the commodity floor. By late 2004, world coffee prices are recovering, reaching $1.20 per pound by 2005. The crisis ends not because the structural problems are solved, but because production growth slows and because a segment of the market, the specialty sector, disconnects partly from commodity pricing. By 2004, across the main producing countries, crop surveys show that an estimated 300,000 farming families have abandoned coffee production. Villages in Honduras and Guatemala have lost between 10 and 30% of their populations to migration to cities or to the United States. The farms do not replant immediately. Some do not replant at all. The supply surplus corrects through human abandonment, rather than through price signals that arrive in time to be useful. Victor Maldonado ran 18 hectares of coffee in the Huila Department of Colombia. He held on through 2001 and 2002 by selling family assets and borrowing from his brother. In 2003, unable to service his loans, he surrendered the farm to the cooperative that had extended his credit and moved with his wife and 3 children to Cali, where he drives a taxi. He is 58 years old. He does not go back to farming. The land is replanted by a larger, consolidated operation that buys distressed farms at below market prices during the crisis and consolidates them into operations large enough to absorb the losses and wait for the price recovery. Victor's loss is their acquisition opportunity. And still, nobody asked the real question. So what does the conventional story say about the coffee price collapse? It says the ICA quota system was unsustainable and that when it ended, market forces produced a necessary correction in an overpriced commodity, and that the pain fell on inefficient producers who would need to improve productivity or exit. That story is the standard development economics framework for commodity markets, and it is wrong in a specific and teachable way. The ICA did not collapse because it was economically unsustainable. It collapsed because the consuming countries' governments, under pressure from the large roasting companies, stopped supporting it. The interests of Nestle and Kraft in cheaper input costs outweighed the interests of 25 million farming families in price stability, and the institutional arrangement that balanced those competing interests was allowed to die. What actually happened in the decade after 1989 is that the coffee market was deliberately restructured to transfer value from producers to processors and retailers. The large roasting companies, the 4 firms that control roughly 45% of global roasted coffee retail, Nestle, Kraft, Procter & Gamble, and Sara Lee, buy green coffee as a commodity. When the commodity price falls, their input costs fall. Their retail prices do not fall by the same amount, because retail prices in consumer goods are sticky downward. The gap between the commodity price they pay and the retail price they charge, their processing and roasting margin, widens when commodity prices fall and narrows when they rise. Between 1990 and 2004, as the commodity price fell from $1.20 to 45 cents per pound, the retail price of coffee in American supermarkets fell by about 25%. The roasters captured the difference. Remember Nguyen Van Hung in Vietnam. By 2004, the price recovery had made him whole again after 3 years of losses. He did not exit coffee. he replanted with higher-yielding cultivars. By 2010, his farm was producing more coffee than it had in 2001 at lower per-unit cost, and Vietnam had become the world's second-largest coffee exporter. The structural condition that produced the 1999 to 2004 crisis, an agriculture sector in a low-income country capable of expanding output faster than global demand grows, did not change. It is running today in Vietnam and in Indonesia, and in Uganda and in Ethiopia and in Brazil. In every commodity where the combination of development, lending, improved cultivation, and smallholder desperation for hard currency income keeps adding supply to markets that are already at capacity, that the pattern across agricultural commodities follows its own version of the bubble formula. The new paradigm in coffee was the Postica belief, promoted by development banks and consuming country governments, that market prices would efficiently allocate resources in global commodity markets and that the ICA's price supports were market distortions harming consumers. In the 1980s, coffee market, this argument was made by economists at the World Bank and the IMF as part of the broader structural adjustment agenda that instructed developing countries to liberalize their agricultural sectors and expand commodity exports to earn foreign exchange. The instruction was followed. The result was a price collapse that lasted a decade. Easy money was the development lending, from the World Bank, from bilateral aid programs, from the Inter-American Development Bank, that funded coffee expansion in Vietnam and other new producers, without modeling the aggregate supply effect of recommending the same crop to dozens of countries. Simultaneously, a 1995 World Bank report on Vietnamese agricultural development specifically recommended coffee as a priority export crop based on the price conditions of the early 1990s. 1999 World Bank review of the same sector acknowledged the price collapse without noting the connection between its own earlier recommendations and the supply expansion that produced. Its social proof was the visible prosperity of coffee farmers during the brief price spike of 1994 to 1997, when a Brazilian frost tightened supply and pushed prices above $2 per pound for 2 years. Every farmer who had planted coffee in that window saw it as validation. Every bank that had lent against coffee land saw the high prices as confirmation of credit. The planting boom of 1996 to 1999, which produced the supply surplus that broke prices in 2001, was funded by the memory of 1994 and 1994. Complexity was the futures market structure that allowed large buyers to hedge their input costs using contracts priced in New York and London, denominated in dollars, subject to the leverage and volatility of financial markets that have no direct connection to the agronomic reality of a farm on an Andean hillside. A Colombian farmer in 2001 could not short the New York Coffee, Sugar and Cocoa Exchange. A Nestle procurement desk could and did. Peak euphoria in the coffee cycle is not a moment of exuberance, but its opposite. It is the quiet confidence of the consuming country institutional consensus. In 1999 that the market was working correctly, that the price fall was a necessary adjustment, and that the human cost was the temporary pain of a necessary transition to more efficient production. The OECD published a 2001 report arguing that higher efficiency among coffee producers was the appropriate long-term response to lower prices. The report does not name the families losing their farms while the transition happens. The trigger in the coffee collapse is not a single event but a structural condition, the simultaneous maturation of millions of trees planted during the expansion years of the mid-1990s, all arriving at peak production capacity at the same time. A global economic slowdown reduced demand growth from the forecast 3 to 4% to under 1%. The blame game blamed the ICA for suppressing efficient market adjustment for decades, blamed Vietnam for dumping cheap Robusta into an oversupplied market, blamed development banks for funding the expansion without coordinating with each other, and blamed the large roasters for using their market power to suppress prices. Each of these is partially correct. None is sufficient. Once you see this pattern, you cannot unsee it. Now look at 2025. The global cocoa price reached $10,000 per metric ton in early 2024, its highest level in nearly 50 years. Within 12 months it had pulled back to around $7,000. The price spike was caused by disease-driven crop failures in Ghana and Ivory Coast, which together produce roughly 60% of the world's cocoa. The crop failure is real, the price signal is real, and right now, in Indonesia and Ecuador and Vietnam and Nigeria, Agricultural ministries and development banks are funding cocoa expansion programs, providing seedlings, credit, and technical assistance to farmers who want to capture the high price. The trees being planted today will reach full production in 2028 and 2029. The supply expansion that a sustained high price signal triggers will arrive in the market, roughly 5 years after the price signal that caused it. By 2029, the high price will almost certainly be gone, replaced by the surplus that the high price created. The farmers who planted in 2024 will be selling into a market that looks exactly like the coffee market of 2001. Sound familiar? New paradigm. The current version in agricultural commodities is the climate resilience narrative, the argument that supply disruptions from climate change will keep commodity prices structurally elevated, and that expansion into new growing regions is a sound long-term strategy. This argument may be correct in a broad 30-year sense. It is almost certainly wrong about the next 5 years, because it ignores the speed with which agricultural supply can expand when prices are high, and development financing is available. Easy money, the green climate funds and development finance, institutions that are currently funding agricultural expansion in sub-Saharan Africa and Southeast Asia are doing so under mandates to improve food security and farmer incomes. The aggregate supply effect of their individual lending decisions is not being modeled at the portfolio level by any institution that has the authority to coordinate across them. Social proof. Cocoa prices at $10,000 per metric ton generate exactly the same farmer and investor behavior that $2.50 coffee generated in 1994. Every farmer adjacent to an existing producing region is asking the same question. Can I plant this? Every agricultural bank is looking at the price and loosening its lending criteria. Every development agency is running a program to expand production in its target country. Complexity. The cocoa futures market, like the coffee market, allows large buyers to lock in prices months or years in advance, through forward contracts and futures hedges that are simply unavailable to smallholder farmers in Ghana or Ecuador. When prices spike, the large chocolate manufacturers, Barry Callebaut, Cargill, Olam, are already partially hedged from prior contracts. The farmers selling spot in 2024 are the ones seeing the full benefit of the high price. The farmers planting in 2024 in response to the high price will sell into the 2029 market at whatever price 5 years of supply expansion has produced. What is genuinely different now? The fair trade and direct trade certification systems that barely existed in 2001 now cover a meaningful fraction of global specialty coffee and cocoa production, guaranteeing minimum prices to certified farmers that insulate them partially from commodity floor crashes. Rainforest Alliance and Fairtrade International certification together cover roughly 25% of global coffee volume. In a severe price crash, the minimum price guarantees provide a floor, though the certification premium is not large, enough to make up the full difference if commodity prices fall to 2001 levels again. That is a real structural difference from 1999. It is not a sufficient one. Watch for the supply expansion. Announcements from major development banks in any commodity where current prices are above long-run average. The IFC's agricultural lending portfolio and the USAID commodity program. Announcements are published quarterly and can be tracked against price cycles. When development lending for a specific commodity accelerates during a price spike, the supply overhang is being built in real time. Watch for the inventory data published monthly by the International Cocoa Organization and the International Coffee Organization, because warehouse stock levels rising above 60-day forward consumption is the early indicator of a surplus that has not yet reached prices. And watch for the currency exchange rates in major producing countries, because a strong dollar makes dollar-denominated commodity prices feel even lower in local currency terms, which is when farmers become most desperate and most likely to expand production at the worst possible time. Not predictions, a pattern. The pattern is there. The question is whether you will recognize it in time. So why do we keep building this trap for the same farmers in different countries with different commodities? The answer is not that development economists are incompetent or that farmers are irrational. Nguyen Van Hung planting coffee in 1991 is rational. His government recommending it is rational. The World Bank funding it is rational, within the limits of what its individual analysts can model. The irrationality is systemic. It appears only when you look at 40 countries receiving the same advice, from the same institutions based on the same price signal and ask what happens to the commodity. price when all 40 follow the advice simultaneously. No individual actor in the system has the incentive or the authority to answer that question. Every individual actor has local incentives pointing toward expansion. This is the mechanism that makes agricultural commodity traps so durable. The people who benefit from cheap commodities, the processors, the retailers, the consumers in wealthy countries who pay less for their coffee and chocolate and cooking oil, are diffuse and anonymous. They do not know they are benefiting from a price collapse that is destroying farming communities in 4 continents. They would probably not change their behavior if they did know, because the connection between a $3 latte in Seattle and a farm abandonment in Colombia is too distant and too mediated by supply chains and futures markets to feel personal. The people who are harmed by cheap commodities are concentrated and specific. They are the farming families in Wheeler and Manor Sales and Daklak and Kumasi who borrowed money against a price that the market dissolved before the loan came due. Their harm is personal and immediate, but they have no political voice in the consuming countries where the price is celebrated. Victor Maldonado drives a taxi in Cali, is not an outlier. He is the predictable outcome of a system that tells poor farmers in poor countries to grow more of whatever is currently expensive, provides them with the financing to do so, and then provides no mechanism to slow the expansion when the collective result of following the advice is a price collapse that makes the advice retroactively wrong. The system does not correct for this because the correction would require coordination across institutions and governments that have no mechanism to coordinate and no incentive to do so. The result is that each commodity cycle teaches the same lesson to a new set of farmers who have not read the previous cycle, because the previous cycle happened to different farmers growing different crops in different countries, and the connection between what happened to Colombian coffee growers in 2001 and what is happening to Ivorian cocoa growers in 2025 requires reading history that is not in any document that Ivorian farmers are given access to. Cannot fix the International Coffee Agreement. You cannot redesign the IFC's lending portfolio. What you can do is extend the chain of consequence when you buy commodities. To think for a moment about the supply chain behind the product and whether the price you are paying reflects a market that is working, or a market that is systematically transferring wealth from producers to processors and from farmers to futures traders. The fair trade premium, $2 more for a bag of certified coffee, does not fix the structural problem, but the aggregated signal of millions of consumers choosing certified products is one of the few market mechanisms available to smallholder farmers who have no other way to communicate with the people who drink what they grow. The coffee crisis of 1999 to 2004 is a documented catastrophe that killed farming communities across countries and generated a literature of economic analysis, development bank reviews, and NGO reports that sits largely unread in institutional archives. The cocoa crisis that may be forming right now from the 2024 price spike will generate its own literature in 2030. Farmers who will be harmed by it are planting trees today because that is the rational response to the price they can observe. History will judge harshly the institutions that could see the pattern forming and did not coordinate to prevent it. Now I want to hear from you. Which commodity do you think is currently in the early stages of the overproduction cycle, where the price signal is attracting supply expansion that will produce a price collapse in 3 to 5 years? And what would a genuinely functional international price stabilization mechanism for agricultural commodities need to look like to survive the political pressures that destroyed the ICA in 1989? Those are not rhetorical questions. Agricultural economists are arguing about both of them right now in journals that do not reach the people whose livelihoods depend on getting the answers right. Drop your thinking in the comments. If this changed how you look at the price tag on your morning coffee or your bar of chocolate, hit the like button and subscribe. Next time, we are going inside the story of how a single country's decision to print money to pay for a war created an inflation so severe that wheelbarrows of cash could not buy a loaf of bread, and what the government that caused it did next, which is the part nobody tells you. History does not repeat, but it rhymes, and right now, it is rhyming loud. See you in the next one.